Hello everyone, and a very warm welcome to this ICAS webinar, the Spring Tax Update Part 2. For those that don't know me, my name is David Mingus. I'm the Director of Practice here at ICAS, and it's my great pleasure to be hosting this webinar today. So our Spring Tax Update series is one of the most popular and highly recommended member technical updates that we provide at ICAS. Well, it's time to allow us to look at the announcements in the budget delivered by the government. The actual substance of the spring budget announcements from Chancellor Jeremy Hunt were rather limited when taken against what was potentially the last major fiscal event before the next general election. However, there are still lots of ongoing developments which affect tax practitioners and general practitioners alike. But this is, of course, the second of our spring tax updates. In the first update a couple of weeks ago, we looked at taxes which impacted on owner-managed businesses, employment taxes and devolved taxes. And if you missed that, then of course you can catch up on demand by heading across, of course, after this webinar at icas.com/events. And if you look under the March 2024 section in the past webinar section, you'll find a recording there. Today, we're going to delve into key developments and look at things to look out for across the main taxes and some general tax compliance work, and also what might be coming down the line as a result of some tax policy work, and of course what member issues have the tax team been taken up with HMRC. So to help explain and help us understand some of these matters, I'm delighted to be joined today by Susan Cattell, who is our Head of Tax Technical Policy at ICAS. Susan works alongside the ICAS Tax Board on the direction of tax technical policy and is also Secretary to the International and Large Business Taxes Committee, the Private Client Committee and the Indirect Taxes Committee. She also represents ICAS and the members on various HMRC stakeholder groups, including the Compliance Reform Forum, the Representative Body Steering Group and the Joint VAT Consultative Committee, as well as sitting on HMRC's Charter Stakeholder Group. Before we begin, we're just going to look at a few housekeeping matters just to remind you of. While I suspect we might not have time to get through questions today, you can, of course, submit questions through the Q&A facility at the top of the screen. And if we don't manage to get to or don't have time to get to questions, we will do them through a document which we'll upload to go alongside the slides on icas.com, which you'll be able to access after the webinar. You can, of course, join the conversation through the chat box, which is also accessed at the top of the screen, and this allows you to comment or discuss with other attendees the various matters that are covered by the webinar. And as I say, we are recording the webinar and we'll make it available for on-demand viewing afterwards in case you want to refer back to it and share it with others. Alongside that, the slides will be available on this page as well. So as I say, we do look forward to receiving your questions throughout the course of the webinar, and I do know that Susan has an awful lot of content to get through. So without wasting any further time, I'll just pass straight across to Susan. Susan, over to you.
Hi Susan, sorry, are you okay to just pop yourself off mute?
Sorry, I took control of the slides and failed to take myself off mute. Elementary error. Sorry, welcome to the General Tax Update. As David says, we've got quite a lot to get through today. We're going to try and pull out the key developments across the main taxes. There were actually a few interesting things tucked away in the budget, so we're going to cover some of those. Also going to look at a couple of really significant consultations on tax regulation and the tax administrative framework. So without further ado, let's get started on personal tax. Now, if any of you came to this webinar last year, you'll get a sense of deja vu here because I have been able to largely recycle this slide almost completely unchanged. And the absolutely key things to note here are that the personal tax allowance continues to be frozen at 12,570. The basic rate limit continues to be frozen at its current level of 37,700, and the higher rate threshold is frozen. And all of those things are expected to remain frozen until 5th of April 2024. 2028. A couple of other things remain frozen, and of course the additional rate threshold was actually reduced from 6th of April 2023 to 125,140, and it remains at that level for 2024-2025. The income tax rates are also unchanged at 20%, 40% and 45%. So I have put a new line on the slide. Was there a thaw in 2024? Well, not yet. And I am going to say not yet, because of course there's been quite a considerable amount of speculation that we might actually get another fiscal event before the general election. So it's just possible that some of these things could change. And of course, when we have the general election, which is almost certain to happen this year, I think it could technically go into January 25. But after that general election, of course, whoever wins it, there might be another fiscal event immediately after the election. So we could see some changes, but that's where we are at the moment. And I think it's quite important to note all those frozen thresholds and allowances, and I'll talk a bit more about that in a moment. So I'm not going to talk about Scottish income tax because, as David said, the webinar a few weeks ago looked at that in some considerable detail. So I just put that slide up so you can see the full scary nature of having 6 bands now. There was an additional one added in the last Scottish budget. So, but if you want more detail on that, do go and listen to the recording of the earlier webinar. So let's now move on to national insurance. This was one of the big headline announcements from the spring budget. So for employees, we've had a sort of two-stage change here, because from 6th of January 2024, as announced in the autumn statement, the rate of NIC for employees was reduced from 12% to 10% for earnings up to the upper earnings limit, which is 50,270. The rate for earnings above the upper earnings limit remains at 2%. And then from 6th of April 2024, which was announced in the spring budget, there was a further reduction in rates down to 8% for earnings up to the upper earnings limit, and we're still sticking at 2% for earnings over the upper earnings limit. And the budget press notice said that the combined effect of those changes was to put over £900 a year back into the average worker's pocket, and I'm going to come back to that a bit later as well. So just turning to the self-employed, we had the removal of the requirement to pay Class 2 contributions, and the small profits threshold was frozen at 6,725. Now, the important thing to note about this is that people who were between the two profit limits, so between 6,725 and the lower profits limit, which is the same as the personal allowance, they've always had NIC credits for the profits where they had profits between those two levels. So the big change from 6th of April 2024 is for people with profits above the small profits threshold, because above the lower profits limit, because they will now not have to pay NIC Class 2, and they will still get the credits towards things like their state pension. Now, those who've got profits below 6,725, they would not have been receiving NIC credits anyway, and they may want to continue to pay voluntary Class 2 contributions, assuming that they've already been doing so, in order to maintain their entitlements to things like the state pension. So the rate for those Class 2 contributions is frozen at £3.45. So if we move on to Class 4, profits above 12,570, the rate is reduced from 6th of April 2024 from 9% to 6%, and it carries on being 2% for profits above the upper earnings limit. So I think the important thing to note here is that for the self-employed, the changes all came in from 6th of April 2024 instead of being in 2 stages as they were for employees. Now, if we look at what the budget press notice said about the self-employed, the saving for the average self-employed worker is going to be £650. And I just wanted to take a look overall at what this all means, because I think it's quite important when you're thinking about people's pay packets and whether they're better off or not. It's quite important, obviously, to look at both the freezing of the thresholds and the personal allowances and at the actual cuts in the NIC rates. So the Office for Budget Responsibility, which reports the government's plans actually said that freezing the tax allowances and thresholds rather than raising them in line with inflation increases tax receipts, as rising nominal wages tip more workers into paying tax or paying a higher rate of tax than would otherwise be the case. This fiscal drag effect is especially pronounced when inflation is high, as it has been over the last 3 years. So it's kind of a stealth tax, this, because people don't notice it so much, but of course it is happening. And the OBR estimated that by 28-29, which, as you'll remember, is when the freeze-on thresholds and personal allowance is expected to carry on until, the OBR thinks there'll be around 3.7 million more taxpayers overall, and 2.7 million more higher rate taxpayers, and 600,000 more additional rate taxpayers than if all the allowances and thresholds had been indexed to inflation and the additional rate threshold had been kept at 150,000. And the OBR also had a look at what the personal allowance might be for each year if it was indexed in line with inflation. And for 2024-5, they thought it would have reached 15,220, which is, of course, £2,650 more than it actually is. And by 27-28, that will be even more pronounced, as you can see, because the OBR think it would be 15,990, whereas on present form, we expect that they will carry on being frozen. So I think that's quite important to note. And the OBR went on to say that overall, the personal tax cuts announced in the 2023 autumn statement and the 24 spring budget reverse around half of the total additional tax revenue raised from the freezing of thresholds to 28-29. So they thought that overall, looking at the period up to 28-29, the changes to the threshold and the personal allowance freezes raised receipts by 41.1 billion, and the reductions in NIC will cut the revenues to the Chancellor by 21.4 billion. So it's really important to bear that in mind and look at the complete picture. And if you're really interested in this kind of thing, the ICAS actually did a more detailed analysis of which employees are more likely to benefit. And the answer is that in 2024-5, and looking at the net effect of all NICs and income tax changes since 2021, basically the IFS thinks about half of employees, so that's 14 million employees earning between about 26,000 and 60,000 a year, will be better off. And everybody else, so earning lower than 26 or more than 60, will be worse off, because the cuts to NICs rates are more than offset by the other tax rises. So I think that's quite an interesting analysis. And the IFS, the Institute of Fiscal Studies, also looked at what would happen by 27-28 if things don't change. And so I recommend going to have a look at that if you're interested. But as I said earlier, of course, there may be further changes, because although the thresholds are said to be going to be frozen until 27-28, a future Chancellor may decide to change that. So now if we move on to look at dividends and savings, now again, some of you will recognise some of this slide, because again, things haven't changed. We knew about all of this before. So the dividend tax rate was increased from April 2022, and so I've got the current rates at the top of that slide, and they haven't changed for 2024-25. The thing that has changed for 2024-25, although as I say we did know about this, is that the tax-free allowance for dividend income has been steadily reducing. For 2017-18, it was 5,000, and then it dropped to 2,000. It stayed at 2,000 for a couple of years, and it's down to 1,000 from 6th of April 2023 and reduced to £500 from 6th of April 2024. The starting rate limit for savings is unchanged, so is the starting rate for savings, and the personal savings allowance is also unchanged. One of the things to note here is I mentioned that the OBR was suggesting that quite a lot of people are going to be brought into paying tax for the first time by the frozen thresholds. You've probably seen some publicity that quite a few of those people are likely to be pensioners, because of course they've benefited from the triple lock when their pensions were increased by a fair amount. They may also have some dividends, and of course they don't benefit from the NIC cuts, because you don't pay NIC once you get past your retirement age. So it's quite an interesting one that they're some of the people who are likely to become taxpayers for the first time. And let's see what's new on dividends and savings. In the spring budget 2024, the government said they're going to introduce a new UK ISA with its own allowance of £5,000 separate from the other existing ISAs. It's £5,000 a year for people to invest in UK focused assets. And there's going to be a consultation on the details to follow. So that's all we know at the moment. But I assume it's obviously going to be something like the Great British ISA to encourage people to invest in the UK. So we carry on. Another really significant change announced in the 2024 budget. We've got the high income child benefit charge. Now, I'm sure all of you will be aware that this was introduced back in 2013. It really shouldn't be a tax. This should be part of the benefit system, because essentially what the high income child benefit charge is doing is restricting access to child benefit for people earning more than 50,000 when it was introduced in 2013. And unfortunately, the tax system, because the tax system operates on the basis of independent taxation, is not very well set up to deal with what amounts to household income. Because unfortunately, the way HICBIC works is it looks at the two partners in a household and says if one of them's earning more than 50,000 and one of them's claiming child benefit, then that child benefit is clawed back through a tax charge. Now, it's gradually clawed back, and so two things have happened in the spring budget. Firstly, the threshold where HICBIC kicks in has been increased to 60,000, and as it hadn't been increased since 2013, that's obviously quite a significant change. The other thing that's changed is that the taper rate has changed. So in the past, you would have had all your child benefit withdrawn by the time you got to 60,000. Now you will only lose all of your child benefit when your adjusted net income of one of the two partners reaches 80,000. And one of the things that doesn't deal with is that there's a strong element of unfairness about HICBIC, because as you can probably deduce from all of that, if you had two people in a household, both of whom earn around £49,000, they wouldn't have been affected by HICBIC. Whereas if you've got a household with only one earner and they earn, say, 55,000, they would lose some of their child benefit. And if their adjusted net income was 60,000, they'd lose it all. That clearly was perceived as being very unfair. So we do have a second stage change coming along. But just before we move to that, just to say that the budget impact assessment notes that they think 485,000 families will benefit from this increase to 60,000 in the threshold and the adjustments to the taper rate. And of those, 305,000 will pay less HICBIC, and of that 305,000, 170,000 will no longer pay any HICBIC. And 180,000 families who would previously have lost most or all of their child benefit will now be eligible to actually have some of that child benefit. So we shall see what happens. Now, just moving on, the government wants to address the unfairness point that I mentioned as well. So by April 2026, they're intending to move HICBIC to a household basis. So to avoid that situation where you can have two people earning 49, or well, it would now be two people earning 59,000, just under the 60,000 threshold, and they wouldn't be affected, whereas a household with only one earner earning 61,000 would be. So they want to address that. So they're going to move HICBIC to looking at a household basis. And they're going to publish a consultation on that, which is going to be really, really interesting to see how they're going to do this, because it's really important not to undermine the principle of independent taxation. I don't know, those of you with long memories may recall the situation before 1990 when independent taxation was introduced, when you had the ridiculous situation of married woman's income was added together with that of her husband and treated as the husband's income, and so on and so forth. So they're obviously going to have to find a way not to do that, because I believe the government has actually committed to not upsetting independent taxation. And it just illustrates again that HICBIC doesn't really work very well with the tax system, and because it's really a form of means testing benefits, which have always operated on a household basis. So watch this space on that one. Also watch this space on this one. One of the unfortunate byproducts of HICBIC was that, well, firstly, lots of people didn't realise they were affected, so there have been lots of tribunal cases when HMRC has been trying to catch up with people and say you should have been paying it. One of the other unfortunate consequences of HICBIC was that some people didn't realise that even if your child benefit was going to be completely clawed back by this tax charge, it was really sensible to still register to claim your child benefit and then opt not to receive it. Now, that might sound a bit silly, but the reason it was sensible to do that was that you still got your credits for your national insurance credits, which are obviously vital towards your state pension entitlement. And also the child would automatically get their NI number at 16. Now, lots of people didn't realise that, and they thought, oh, actually, well, I'm not going to have any child benefits, so I just won't bother claiming it. Now, the government has been told about this repeatedly over the years, and they're now going to do something about it. They're going to introduce a system whereby those people who missed out on their credits because they didn't claim tax benefit will be able to apply to get them. Now, we don't know how this is going to work. It's going to be put in place from April 26. There will be some transitional arrangements to let you claim back to 2013, because otherwise that would be out of time. So really important, if that's relevant to you, to watch this space and make sure you know what you have to do to make the claim. So moving on to capital gains tax. This is another bit of deja vu, really, because again, this hasn't changed. Basically, the capital gains tax annual exempt amount has been gradually reduced. So 2022-3, it was 12,300, then it dropped to 6,000 and 3,000 for most trustees. And then from 2024-5, it's permanently fixed at 3,000 for individuals and personal representatives and 1,500 for most trustees. And the CGT, oh, sorry, I've taken that off the slide. Let me just move to the big change this year. From 6th of April 2024, the higher rate of CGT for residential property gains is reduced to from 28% to 24%. The other CGT rates remain unchanged. And if some of you were glued to Jeremy Hunt's budget speech, you might remember that at this point in his speech, he said that he was making a tax cut that would actually raise revenues, and that might have raised a few eyebrows. But the reason he was able to say that is because the OBR had a look at this, the Office of Budget Responsibility, and they noted that this cut in the CGT higher rate for residential property was expected to raise revenues because it would unlock some disposals in the short term. So people who hadn't been selling because they didn't want to pay at 28% might now decide to sell that property, particularly if they think that this change might be reversed in the not too distant future, I should imagine. The OBR also expects a small permanent positive effect on the level of transactions, i.e. more people will decide to sell some property. So that's where they expect there to be additional revenues, and most of those additional revenues are actually going to come from the SDLT associated with the fact that more people are buying and selling property. Now, they do expect certainly the first bit of that, the unlocking of disposals, to sort of wind down. So by 28-29, they think that the overall effect might be a small net cost to the Exchequer. But in the short term, certainly they expect more revenues from this for the government. So that's why Jeremy Hunt was able to say that in his budget speech. Right, moving on to inheritance tax. Well, it won't surprise you to learn there's been no change there. The nil rate band is still fixed, expected to be fixed until 27-28. So it's 325,000, and the residential nil rate band is also still fixed at 175,000. Now, that doesn't have a huge impact because the vast majority of estates, well over 90% of estates, are forecast to have no IHT liability at all in the years to 27-28. At the margin, it's expected that the freeze will bring in another 700 additional estates into having to pay inheritance tax. But again, you know, a future Chancellor might change this. There was, of course, quite a bit of speculation that the Chancellor might do something about inheritance tax, and then it didn't happen. But who knows what might happen in the future. Now, there were actually some changes to inheritance tax announced in the spring budget 2024. And the first one's quite an interesting little thing, which might make it easier for some executors and personal representatives, because essentially at the moment executors are required to pay all or part of the inheritance tax due on the deceased's estate before they can obtain a grant of probate or confirmation in Scotland. But the trouble is that until they get the grant of probate, they can't access the deceased's assets, so they may not actually have any money to pay that inheritance tax that would allow them to get the grant of probate. So quite often you find that estates have to take out a short-term commercial loan, and then once they've got probate and they can sell the assets, they can repay that loan. But that can actually be quite expensive. And prior to this announcement, it was only in the most exceptional circumstances that HMRC would let you apply for a grant. So you would apply for a grant on credit, so you'd get the grant without having paid the IHT. But in order to get that, you had to show that it was impossible for you to raise the money, and that includes showing that you had tried to get a commercial loan. And as you can see from the slide, that has now been relaxed. From 1st of April 24, personal reps of estates will no longer need to have gone and looked for a commercial loan before applying for a grant on credit. So that should make life just slightly easier for some estates. I think this was covered on the webinar a few weeks ago, so I'll just put it up very quickly. The government did announce that they are going to legislate to extend the scope of agricultural property relief to environmental land management from 6th of April 2025. Now, it's obviously quite good news if you want to encourage people to put land to eco-friendly uses. But of course, people would have been concerned about doing that if they thought it meant they were going to lose their agricultural property relief for inheritance tax purposes. And you can see the second bullet just sets out when the relief will be available, you know, what's the meaning of an environmental land management. And there's also, because there were still some uncertainties about the tax treatment of other aspects of ecosystem service credits and associated units, amongst other things, there's going to be a joint working group set up between the Treasury, HMRC and some industry reps to look for solutions on that, to try and clarify the treatment. Because again, if you want to encourage people to do something, it helps if they understand what the tax treatment will be. And then another little change that was tucked away in the budget papers is that from 6th of April 2024, agricultural property relief and woodland relief is restricted to property in the UK. So some property that would have qualified before in the European Economic Area, the Channel Islands and the Isle of Man gets treated the same as other property located outside the UK. So obviously important to know about that if it happens to affect you. Right, going on to something much bigger, much wider significance, the abolition of the furnished holiday lettings regime. Now, I'm not going to go into how you qualify for the furnished holiday lettings regime, because I'm sure most of you are broadly familiar with that. You know, you have to have the holiday property available for letting a certain number of days a year, and it has to be actually let for a certain number of days. And the point about furnished holiday lets at the moment is that they get very favourable tax treatment, including they can claim capital allowances on things like the furniture and white goods in the property. They can have access to various capital gains relief, so things like entrepreneurs relief or business asset rollover relief, and a few others. For pensions purposes, the furnished holiday let profits are treated as relevant earnings. And the also really importantly, your deduction for finance costs, so things like mortgage interest, is not restricted, whereas of course it is restricted if we're talking about ordinary lettings to long-term tenants. So it was really beneficial to be in the furnished holiday lets regime. Funnily enough, the only area where there wasn't beneficial, aside to being in the FHL regime, was inheritance tax. And that's why over the years you have seen a few tribunal cases where people have had a furnished holiday let, and obviously they qualified for all these beneficial income tax and CGT treatments, but then they found that for inheritance tax, it didn't qualify for business property relief. So you did see some tribunal cases with people trying to argue that their furnished holiday let was, they provided so many services that it was actually a trade. And so that's quite an interesting one when we look at what's going to happen now that the FHL regime has been completely abolished for every purpose. We're promised draft legislation. It's going to be abolished from April 2025. We're promised draft legislation in due course, which is going to include some anti-forestalling measures. And the anti-forestalling measure is going to stop you getting a tax advantage through the use of unconditional contracts to obtain CGT under the current FHL rules. And that anti-forestalling rule is going to apply from 6th of March 2024. Now, I'm sorry to say, and we've been asked about this many times already, we don't know any more than that. That's all we know. And now I'm conscious as I say that today is Tax Administration and Maintenance Day. So we are expecting some more publications out today. So it's just possible that something might be published that sheds some more light on this. But other than that, I'm afraid we don't have any sort of extra information beyond that was published on Budget Day. So that's obviously something that people need to be watching out for if they've got furnished holiday lets and they were thinking of making a disposal and claiming some of those capital gains reliefs. The other question, and I say this ties into the point I mentioned earlier about whether the furnished holiday letting might amount to a trade. So should the government introduce a statutory bright line test to define when a property trading business is being carried on? Because the problem is that, unfortunately, otherwise, if they don't introduce a bright line test, we're going to see lots more tribunal cases, because there will be people who say, well, I do lots and lots of services. My furnished holiday lets may be a bit closer to running a hotel, just with some self-contained units, if you like. And it should be a trade. I still want the benefit of all those capital gains reliefs and everything else. And if the government wants to avoid lots of disputes, and this is something the Office for Tax Simplification recommended a few years ago, if you're going to abolish FHLs, maybe you need to bring in a statutory bright line test to avoid the sort of disputes that I say have already come up for inheritance tax purposes. Right, final thing on personal tax, some really important announcements in the spring budget. And I think obviously this had a lot of publicity because clearly this was the Conservative government stealing an idea from Labour, if you like, having previously said that they weren't going to do anything with the non-dom regime. But in fact, what they are going to do, and I should stress, these are all proposals. They're proposals. We don't have all the details yet. And of course, the Labour Shadow Chancellor has already indicated that if Labour win the election, she will not be sticking to all of these. So I think that's really important to bear that in mind, that these are not concrete. These are not definitely going to happen, if you like, or not happening quite this format. So the key thing here is that new arrivals, so that's people who've not been resident here for 10 years, will have no tax on their foreign income and gains for the first 4 years of tax residence, and money can be brought in without any additional charge. So if you'd already got money offshore, you could bring it in. There'll be no charge for opting into the new regime, and existing eligible residents, so if you were already here but you haven't been here for 4 years, you'll be able to benefit up to the 4th year of residence. And then there are going to be some quite generous transitional rules for existing non-DOMs. They'll get a temporary 50% reduction in personal foreign income subject to tax for a year. This is people who are currently eligible for the remittance basis, currently using the remittance basis, but are not eligible for the new 4-year exemption. They'll also get an election to rebase capital assets to 5th of April 2019. There'll also be the ability to remit foreign income and gains that arose before 6th of April 2025 to the UK at a special rate of 12%. I think that's one of the things Rachel Reeves has already said she's not going to do. No, actually, sorry, it was the temporary 50% reduction. I think she's already said she's not going to do, but I mean, obviously she could have certainly reversed quite a few of these things. And finally, I'm not going to talk about this one in detail, but the protected non-residence trusts will not be protected for any new foreign income or gains after 6th of April 2025. FIG arising before that will not be taxed unless it's distributed to people who've been resident in the UK for more than 4 years. A few other linked proposals. We know that there's going to be that it's proposed that overseas workday relief is going to be reformed. Now, we really don't have any great detail on that beyond what's on the slide, because as you'll see, they're going to have a consultation on who will be eligible for this in due course. So I'm not going to say any more about that. Now, the other really big proposal, and I think there's been quite a lot of surprise that this came from a Conservative government, is that inheritance tax is also going to move to a residence-based regime. So broadly speaking, an individual's non-UK assets will be within scope once they've been resident for 10 years, and a 10-year tail will apply for individuals who leave the UK. Now, there are going to be some special rules for non-UK assets that had already been put into excluded property trusts set up by non-doms before 6th of April 2025. They're going to remain under the current rules, but going forward, the status of this kind of thing, if you settle it from 6th of April 25 onwards, will be under this new IHT residence rule. Now, again, that's something that Rachel Reeve, I think, has already said that she won't, if Labour win the next election, she won't be going with that. So I think the important thing is to watch out for the policy consultation on the full details of all this, and of course also watch out for what happens in the general election. And the problem for advisors at the moment is that there is so much uncertainty. It's very difficult to give any sensible advice. I just pulled out a few headlines from the newspapers there to give you a flavour of what's, I suppose, causing most concern and what advisors are being asked about. I think it's quite amusing that it says petrified non-doms poised to flee UK over Labour's tax plans, because if you actually read the article, some of these advisors are talking about people jumping on planes now, which is, of course, not to do with Labour plans necessarily, but more to do with what the Conservatives have already announced. But it's very obvious from the headlines that one of the key, and from the articles themselves, that one of the key areas of concern is inheritance tax. Now, if you want to sort of balance to that somewhat frenetic coverage, it's worth looking. There was a very good article in Tax Journal recently by a tax practitioner who advises non-doms, saying that, you know, the really important thing is to think what people might do if and when the reforms are actually passed, but you know, take the time, think about it, and also wait to see all the further information, because, as I say, at the moment we really don't have all the details. Right, moving on to business taxes. The corporation tax rates have not changed, so nothing on that slide has changed. We've still got main rate 25%, small profits rate 19%, and marginal relief. What has changed is the capital allowances full expensing, originally only introduced, it was introduced for 3 years, and there was a lot of feedback to the government to say, well, that's not much use. This is from very large corporates, because they plan their projects on 10-year time frame. So 3 years isn't enough of an incentive to make you take up more projects. So in the autumn statement 2023, full expensing was made permanent. And we also know from the budget this year that there's going to be a consultation on extending full expensing to plant and machinery for leasing, because, as you'll see from the little bullet points above, at the moment full expensing assets for leasing are excluded other than certain types of background plant in a building. So that's an important one to watch out for. There is a working group that's already been discussing how that might work with the Treasury and HMRC, and ICAS have been members of that. It's fair to say that one of HMRC's main concerns is possible abuse, because historically there's been a certain amount of abuse of the capital allowances regime in the leasing sector. So it'll be interesting to see the proposals on that when we get them. There's also another working group which was announced at the autumn statement 2023 that's been discussing possible reforms to capital allowances in the light of the introduction of permanent full expensing, but its scope is actually really limited. So, for example, it's not covering things like structures and buildings allowance. It's really just things like first year allowances and the like. And the problem with that is that, as you can see from the little bullets at the top of the slide, full expensing doesn't apply to non-corporates. It's only for corporates. So, of course, you start abolishing other things. That's a bit unfortunate if you're a large non-corporate and the AIA 1 million allowance just simply isn't enough. So I think that maybe that particular review isn't going to produce sort of any major changes, but we are again members of that working group, and we will be making a submission on that. So if you have any thoughts, do drop an email to the tax mailbox, and the address for the tax mailbox is going to be on a later slide. I did just want to say a few things about research and development. If you came last year, we were talking all about the rate changes and the proposals for the merger of the SME scheme and the RDEC scheme for large businesses. So this time, I just want to focus on a few practical things, really important for reasons that you'll see in a moment. So just to note that two important things were introduced in the course of 2023. So first up, claim notifications. Accounting period starting on or after 1st of April 2023. Some companies have to tell HMRC that they're going to make a claim for R&D tax relief, and they have to tell HMRC in advance. And you can see on the slide that they have to submit this via an online form no later than 6 months after the end of the period of account. Really important to go and look at HMRC's detailed guidance on that. And you can see APs starting on or after 1st of April 23, 12 months counting periods. Now's the time to really start thinking about whether some of those companies need to put in a notification. And go and look at the guidance and make sure it's obviously also important to get it right. And the guidance also says which companies need to do it, because it's not absolutely every company. Additional information forms from the 8th of August 23, any company making an R&D relief claim has to complete an additional information form to accompany the claim. If you submit a claim without an AIF, it will be invalid. And HMRC actually gave us some figures last summer, which I've posted on the website, because initially when this first came in, people simply didn't realise. So they were submitting without the AIF, and HMRC were taking the claim out. So, and now that was okay if you had time, if you weren't up against a time limit, because you could go back and start again and get the AIF in at the same time as the claim. If you're up against a time limit, it's obviously much more drastic. So again, there is detailed guidance from HMRC on who can submit it and what you need to put in it. So do go and look at that. ICAS gave written and oral evidence last year to a House of Lords committee which looks at the draft finance bill every year, and we gave evidence on the proposals for the merged scheme, the merger of the SME and RDEC schemes. And also we gave evidence because in April 23 the government introduced an additional relief for R&D intensive SMEs. Now you'll see immediately that that undermines any possible benefits from having a merged scheme, because the whole point of having a merged scheme was to make it simpler and have one scheme for everybody. So now we've still got two schemes, because in spite of evidence from people like us saying actually maybe do this in a longer time frame and make sure you've got one scheme that could include some extra relief for certain companies. But instead what happened was that the merge scheme goes ahead. So the merge scheme, and it's going ahead from the original proposed date, which is 1st of April 2024. Additionally, the restriction on expenditure on overseas R&D activities that was originally going to come in a year ago but was delayed, that is now coming in also from 1st of April 2024 as part of the merge scheme. And we still have this separate scheme for R&D intensive SMEs. The only difference with that is that last year the intensive threshold was 40% of your total expenditure related to R&D, and that's now been reduced from April 24 to 30%. So and one of the most unsatisfactory things about all this is that the time frame meant that HMRC are going to try and cover a lot of the detailed points on difficult areas like contracting in guidance, and they published some draft guidance earlier this year for consultation. So that's going to be really important when looking at this new regime. But to say it's not terribly satisfactory, but there you are. The other thing to watch out for is that in order to, I'm sure all of you are aware there's been a lot of abuse of R&D tax relief, and part of the business model of some of the rogue advisors who have been instrumental in that abuse is to get themselves nominated to receive the payments on behalf of the company, or to have payments assigned to them. Now all of that's been stopped from claims made on or after 1st of April 2024. Now there are some exceptions which make sense, you know, if the nominee is a connected party, but also in exceptional circumstances. Now if you want more detail on that, go and have a look at HMRC's corporate intangibles and research and development manual, and I've put the paragraph number on the slide because there's detailed guidance about that in there. The last thing I wanted to mention is that last autumn November 2023, HMRC really published this really helpful guideline on how to work out whether your work qualifies as R&D for tax purposes, because it's not the same as just general R&D, if you like. So what a company might call R&D doesn't necessarily qualify for tax. So there's a really useful guideline for compliance, GFC3, that came out in November 2023. So very helpful, worth a look. I also just wanted to mention to you, in case you hadn't realised, there are now these guidelines for compliance. There have actually been 4 or 5 of them now, and they've got their own webpage on gov.uk, but if you don't know that they exist, you'll very easily miss them. They were introduced as part of the review of tax administration for large businesses, but unfortunately they don't just relate to large businesses. There's already been one for employers, there's been one on VAT, and they're relevant not just to large businesses. So it's really important to know that they're there. We have already suggested to HMRC that it would be much better to put this guidance into other sources that people already know about. But I think because came out of this review of large businesses, they felt that they'd got to stick with it. So that's where they are. So it's really important to keep an eye on what they're publishing. And the other reason I really wanted to draw your attention to this is because we understand ICAS has been calling for them to HMRC to publish some clarification on the treatment of VAT and cladding in the aftermath of the Grenfell tragedy. And we've been calling for HMRC to publish that since 2019. And we were hoping that it was going to come out as a GFC and possibly an accompanying revenue and customs brief at the end of last year. It's been delayed, but we are still expecting it by around May this year. So keep an eye open for that, and also do keep an eye open in general for the GFCs. Right, moving on to VAT. I'm going to have to be careful not to say too much about this because I can see time is running short, but I happen to have a particular interest on this because you'll see that on the slide, I've put up an article that I posted on the ICAS website just before the spring budget, all about whether we should have another look at the VAT threshold, because the VAT threshold has been frozen since at 85,000 since April 2017. The freeze had been expected to continue to April 2026. And what happens when you have a frozen VAT threshold is that lots of businesses, in order not to cross the threshold, they try and artificially keep their turnover below 85,000. So maybe they shut their doors for 2 months in the summer, or they don't take on an extra employee so they can do more work. And so you get a huge number of firms hovering just below the threshold. And as you can see, the OTS pointed this out and said it wasn't desirable. The Office for Budget Responsibility said that it was getting worse. And the OBR reckoned that by the end of the freeze in 2026, they saw, relative to 2017 and 18, the number of firms who were capping their turnover would have almost doubled from 23,000 to 44,000, with the associated lost turnover expected to be up to 350 million. Now, it's not as simple as saying, oh, well, in that case, just put the threshold up by a lot, because we've already got one of the highest thresholds in the world. And there are a few disadvantages to that, which the OTS had a look at, including the fact that the government loses lots of revenue. But the trouble is that what the Chancellor did in the spring budget, as I'm sure you know, is he increased the threshold by a small amount to £90,000. And there's been similar increase in the deregistration threshold. The only problem with that is, of course, that we've had very high inflation. So it's highly likely that all that will happen is the bunching will move slightly. And all those businesses who were, shutting up shop to keep under the 85,000 threshold, most of them will still be doing the same thing to keep under the 90,000 threshold because of inflation. There are some stats in the impact assessment about the government thinking that it may be 0.6% of businesses currently on the register might not need to register. But the problem with that, I think, is that some of them may be voluntarily registered because if they're in a repayment position, they may want to be registered for VAT. So I think, to be honest, a lot of what I put in the article is still highly relevant. Maybe there should be some more thought on the VAT threshold. So do go and have a look at that if you have a spare moment. Right, the other thing to note on VAT, and I just wanted to highlight that the VAT registration service was launched in August 2022. There were lots of issues with that, which we were raising with HMRC. A lot of that's been now sorted out. There have been quite a few improvements, and note that HMRC are now processing VAT registrations within their service level agreement, which is 40 days. And in fact, most registrations will go through much quicker than that. You do still get the odd outliers where HMRC need more information and so on, but overall the position has much improved. We are a member of the JVCC VAT registration working group. I'm the rep on that, and we do carry on raising issues. So, for example, I raised some issues with the VAT registration mailbox at the end of last year, and I've just raised some recent ones that have been reported to me. So if you are having any difficulties around registration, do drop an email to the tax mailbox because I will try to feed them in. And we've had a bit of a success this year. I'm not going to talk through this in huge detail because I'm looking at the time and there's two more things I really want to get to. But just to note that there was a big problem for people who wanted to register voluntarily for VAT due to the fact that they were making specified supplies. And what was happening was that their applications were just being automatically rejected because of the standard industry classification code on the application. Because in most cases, people with that SIC code would be making exempt supplies. And HMRC listened to the fact that we were telling them there were big problems with this. We reported it last year and then we reported it again through this working group. And I'm pleased to say that from February, they've changed it. So if you are making an application to register for VAT voluntarily because of specified supplies, go and have a look at VAT Notice 700/1 paragraph 2.7, and it tells you what to put on the registration form to ensure that it doesn't get automatically rejected. Might be rejected for other reasons, but not just because of the SIC code. Right. There's the VAT Notice reference. Let's go on. I've got two more really important things that I just want to touch on. The first one is a really important consultation that was launched on Budget Day. And this is looking at, this is part of a programme of work that's been going on since 2020. Because the loan charge review recommended that the government should look at standards in the tax advice market. They were very worried about the fact that a lot of people who'd got into disguised remuneration schemes and ended up subject to the loan charge, they'd had advice from what amounted to rogue advisors. And the government, there's been a series of consultations. The government decided not to proceed with mandatory professional indemnity insurance for anyone who wanted to give tax advice. That was probably a very good thing. There were some proposals in 2022 specifically to deal with repayment agents, which was identified as a problem area. Those are either have been implemented or are in the process of being implemented. In particular, the use of assignments for income tax, which was part of the business model of repayment. A lot of repayment agents that was abolished earlier this year. Last year, and we're now at the next stage, and this is a very important consultation published on Budget Day, which is looking at whether there should be some kind of mandatory regulation of agents in the tax advice market. Because HMRC has done some research that shows that lots of taxpayers think that tax advice is regulated, rather like lawyers, solicitors. A lot of taxpayers think that all tax advice is regulated. So when they go to an unregulated advisor who doesn't belong to a professional body, they just don't realise that they might never have had to take any exams to show they know something about tax. They might not have to have PII cover, and so on. Now, of course, some of those unregulated advisors may be ex-HMRC and perfectly fine, but the trouble is that people don't know and they just assume that it's regulated in the way that solicitors are, but of course it isn't. Now that might be about to change. The first proposal in the condoc, and I suspect this one's going to go ahead whatever, is mandatory registration of all agents with HMRC if they want to interact with HMRC. And HMRC will then check that every practitioner is registered for AML supervision and is up to date with their tax affairs, and then they'll periodically recheck that. Now, a lot of people thought that was already happening, but in fact it wasn't. So I think that will go ahead. The future is that we might have one of three regulatory models. The first would be that everybody who wants to give tax advice, although there's a sub question, if you like, about whether that's people who want to interact with HMRC or anybody who wants to give any kind of a tax advice, would have to belong to a professional body. And those professional bodies who could take part in this would obviously have to be defined and agreed. The second option is to have HMRC regulating those who don't belong to a professional body and the professional bodies regulating those who do. And the third would be to have a government body doing regulation, a new independent regulator or an existing regulator with an expanded remit. Now, if you find this interesting, we're very interested in members' views about this. There is an article on the website which goes into a lot more detail than obviously I've been able to do today, and we welcome your input if you want to send an email to the tax mailbox. Last thing I want to just have a look at is another important call for evidence. This time it's on tax administration, and this is looking at HMRC's powers for inquiry and assessments. It's looking at penalties and taxpayer safeguards. This call for evidence closes on the 9th of May. We are going to submit a response, and again, we'd welcome input, although it would have to be fairly soon for this one because we haven't got much time left. It's in 3 sections, and the first one is looking at whether we could align inquiry and assessment powers across direct and indirect taxes, or whether we could look at certain types of taxes where a common approach would work and design appropriate powers. The second is looking at penalties and whether they could be simplified, because at the moment they're incredibly complicated and there are so many different ones that they're probably not that effective as a deterrent because people just haven't got a clue what the penalty would be if they do or don't do something. And also looking at whether penalties could increase if you carry on being non-compliant or if you repeat non-compliance year on year. The other option is possibly to regularly uprate some of the fixed penalties, so uprate in line with inflation possibly, although given that that would produce some rather funny figures, might be better to leave it for a few years and maybe go from 100 to 150 to 200 rather than going up in line with inflation and going 100, 108, 120, you know. So that's another. The safeguards one is looking at maybe aligning how appeals are made and payment requirements. So one key difference at the moment between direct and indirect taxes is that for indirect, you have to pay the tax before you can appeal, or you have to try and prove to HMRC that you'd suffer hardship. You do get cases going to the tribunal there saying, I just can't pay the tax, but I still want to appeal. So I think a lot of people will probably support the direct tax approach there, which is that you can usually postpone the tax. Encouraging the take-up of statutory review and ADR, which might include an opt-out approach, so you get statutory review unless you opt out. Or the other thing HMRC would like to do is withdraw the option of statutory review in some cases where they think it's being used to delay payment. And I haven't come across anybody who supports that because it's obviously undermining a key safeguard. And I think the thing there is that if HMRC carried out the statutory reviews within the statutory time limit instead of asking for extensions, it really wouldn't delay payment by that much. I'm very conscious that we're now up against it time-wise, so I'm going to skip through these final slides, mainly because Making Tax Digital was covered on the webinar a few weeks ago, and it's mainly about the extension to the pilot. And tax simplification, well, if you have time to play the recording, you can have a look at the slide on that, which is pretty self-explanatory. Just to note, and I've already mentioned several examples of this over the course of this session, we take up a lot of issues with HMRC, and we get them reported to us by members, use the tax mailbox to do that, and we will take those issues to HMRC. We can't always find a solution, but as I've already mentioned today, sometimes we do get things improved, we do get things changed, so definitely worth telling us about that. And just finally, that's where the tax mailbox address is. It's the top one there. Send us your input to tax@icas.com. And we're now coming up to 11:59, so I'm very sorry we ran right to the end of time, but I hope you found that interesting, and I'll look forward to seeing you again at the next Spring Tax Update.
Susan, thank you very much for that rapid fire through all the developments there certainly today. I mean, I think just one thing I want to just pick up is on that regulation piece, and I really just want to just launch a quick poll just now for everyone that's on, but just on the raising tax standards, which model of regulation considered in HMRC consultation would you support the most? So if people want to just submit your responses to that, I'll come back to that in a second or two. But just going forward, just please, as Susan mentioned, remember that you can keep up to date with the latest information and other news on ICAS.com. And you can also access the technical support through the technical help desk, and also in relation to the ICAS tax stuff through the tax email address. So I'm just going to go back to the results on that poll, and overwhelmingly I can see that 75%, so 3/4 of people think that mandatory professional body membership is the way to go. Really nobody, only 3%, looking at regulation by a government body, and a joint approach accounting for the other 22%. So that's really helpful for us when we come to put our ICAS response into the consultation on that. So thank you very much for that. Just looking forward to future ICAS webinars. We do have a range of webinars coming up in the weeks ahead. On the 15th of May, Justine Riccomini, the ICAS Head of Tax for Devolved Taxes, will be hosting a in conversation webinar with officers from the Scottish Government Tax Directorate to explore devolved taxes currently in play in Scotland and how the Scottish Government goes about its daily business with the Tax Directorate. So that's one to look out for. On the 23rd of May, we have a employment and immigration law update for accountants, when I'll be back alongside experts from Anderson Strathearn, Don Dixon and Mark Templeton, to find out how recent changes in law, which have just come in at the beginning of April, how these could affect your business and your client base. And the other one, just to highlight, is on the 5th of June. Do please join us for an in-person ICAS practice conference, where we'll be navigating the future, bringing together a range of expert speakers to explore the challenges facing accountancy practices and how to overcome them. This year's conference is going to delve deeper into those challenges, from attracting and retaining staff to keeping up with the latest technology, and most importantly, we'll offer practical strategies to navigate the evolving landscape. So do please sign up for that, which is an exclusive member in practice conference. It is open to all levels of people within your practice. It doesn't have to be ICAS members, so do please join up for that as well. The link to sign up to all those ICAS events are available at icas.com/events. We have, as I say, slightly overrun by a couple of minutes, so it does only leave me to thank Susan once again for her excellent insight, and of course to you, the audience, for joining and participating in the webinar today. I do hope that the webinar has been helpful to you. Do please participate in the poll to give your feedback on this webinar, and until the next time, goodbye.